Tips for buying your first rental property. 1. Weigh between which is better, cash or mortgage. If you have the means to pay for an investment property in cash, getting a mortgage could still make sense for your situation, especially if you're planning on getting multiple investment properties. For instance, let's say that you have $100,000 sitting in the bank. Your first option is to buy a house in cash for $100,000. While you'll get a larger cash flow on that investment, it ties up all of your cash in a single place. If, however, you get a loan with 20% down, you could potentially purchase another house or two at the same price with the remaining $80,000. While your immediate cash flow is lower, these returns will grow in the long term, especially as rents increase and the mortgages get paid off. You're building assets at a quicker pace when you go with a mortgage instead of cash. 2. The 1% rule. A big question from new investors is, how much should I rent a property for? Seasoned investors sometimes use the 1% rule, which states that the rent each month should be at least 1% of the purchase price. For instance, if you purchased a house for $100,000, you would need to charge, at the very least, $1,000 for rent. This, of course, isn't always true for investors, and some will settle for a slightly lower return. In order to make sure that a potential property can receive that kind of return, see if you can get rental estimates for similar area properties. You may be able to charge slightly more or less than what's listed, but it does give you a ballpark number. 3. What credit score and down payment do you need? For a fixed-rate mortgage, the minimum credit score requirement on a single-unit investment property is 620, and it will require a 20% down payment. If you have a credit score of 720 or above, however, you are only required to put down 15% on a single-unit investment property. For an adjustable-rate mortgage, the minimum credit score is 620 and will require at least 15% down on a single-family investment property. Other than the down payment, the requirements for a rental property are somewhat similar to that of a mortgage for a primary residence. You'll still need to follow the 2-2-2 rule. Provide 2 years of tax returns, 2 years of W-2s, and 2 months of bank statements to your mortgage company, as well as have your assets verified. Your mortgage company will also want you to have 6 months of mortgage payments in reserve in order to give yourself some buffer room in the event that you go through an unexpected financial challenge. 4. How do you determine the potential ROI for a rental property? When looking for a great investment property, the first question you need to ask is, can I actually make money? If the answer is no, it's obviously not a great investment. To see how much money your property could potentially make, you'll need to consider the return on investment, ROI. The ROI can be calculated by first finding the property's net annual income. This is the rent money that is left over after you have paid the taxes, insurance, property management fees, expected repairs, potential vacancy periods, HOA fees, if applicable, and any utilities that aren't going to be covered by the tenant. To find the ROI, take the annual income and divide it by the amount you spent on the property. For example, if the net annual income is $7,500 and you spent $100,000 for the property, your ROI is 7.5%. Use this calculation to see if each rental property is a good potential investment. 5. Pay down personal debt. Savvy investors might carry debt as part of their portfolio investment strategy, but the average person should avoid it. If you have student loans, unpaid medical bills, or children who will attend college soon, then purchasing a rental property may not be the right move. 6. Find the right location. The last thing you want is to be stuck with a rental property in an area that is declining rather than in a stable or growing steam. A city or location where the population is growing and a revitalization plan is underway represents a potential investment opportunity. When choosing a profitable rental property, look for a location with low property taxes, a decent school district, and plenty of amenities such as parks, malls, restaurants, and movie theaters. In addition, a neighborhood with low crime rates, access to public transportation, and a growing job market may mean a larger pool of potential renters. If you don't have paying tenants, your investment property is not good for much. You want to make sure that your property is attractive, not just to any tenant, but to good tenants who pay on time. Depending on your location, some places just tend to have lower vacancy rates, such as San Jose and Fort Collins. You can do some research on the neighborhood you're looking at, but when it comes right down to it, spend time driving around the streets near your potential property. Simply looking at the level of care given to the houses in the surrounding area can give you a good idea of which houses are vacant and which are not. 7. Beware of high interest rates. The cost of borrowing money might be relatively cheap in 2022, but the interest rate on an investment property is generally higher than a traditional mortgage interest rate. If you do decide to finance your purchase, you need a low mortgage payment that won't eat into your monthly profits too much. 8. Factor in unexpected costs. It's not just maintenance and upkeep costs that will eat into your rental income. There's always the potential for an emergency to crop up, roof damage from a hurricane, for instance, or burst pipes that destroy a kitchen floor. Plan to set aside 20% to 30% of your rental income for these types of costs so you have a fund to pay for timely repairs. 9. Avoid a fixer-upper. It's tempting to look for the house that you can get at a bargain and flip into a rental property. However, if this is your first property, that's probably a bad idea. Unless you have a contractor who does quality work on the cheap, or you're skilled at large-scale home improvements, you likely would pay too much to renovate. Instead, look for a home that is priced below the market and needs only minor repairs. The exception to this rule is, of course, if you're knowledgeable about home repairs. If you have extensive handyman skills, or know someone who does, you may be able to deal with these extensive repairs better. But as a general rule, it's going to be less of a headache to just purchase a house that's already in workable condition. 10. Invest in landlord insurance. Protect your new investment. In addition to homeowners insurance, consider purchasing landlord insurance. This type of insurance generally covers property damage, lost rental income, and liability protection. And in case a tenant or a visitor suffers injury as a result of property maintenance issues. 11. Is an investment property right for you? Buying a rental property isn't for the faint of heart. Not only do you have to consider the mortgage and the operating costs, but you also have to think about the tenants who can either make or break your investment. There is usually more risk involved with owning a rental property than investing in the stock market. After all, if you manage to get stuck with bad tenants who don't pay rent on time, your returns aren't just reduced, they're non-existent. Sure, the stock market may only be pulling in 4% to 5% annually, but you can count on that with some level of confidence. You're taking a bigger gamble with an investment property. But with a bigger gamble also comes the opportunity for a bigger reward, and this is especially true for investment properties. In 2021, the average gross yield for rental investors was 9.8%, which is slightly down from previous years but still significant. For some context, the average annual return on the Dow Jones over the last 10 years has been 4.8%. In addition, you have more influence over your investment property than you would the stock market. For example, even if you bought every bottle of Diet Coke in your local grocery store, you probably wouldn't be able to affect Coca-Cola's stock price, at least not noticeably. There are so many factors at play. When it comes to the stock market, you're riding a wave that's already in place. With an investment property, though small changes, such as a new door or some minor improvements to the kitchen, can improve the likelihood of wooing good tenants at higher monthly rents. With investment properties, not only are you riding the wave, but you own the wave. It's a great choice for that investor who wants a more hands-on opportunity.